So I guess we can start our class now while others will join us as we move on. So tonight we are going to be rounding up on financial instruments. That's what we have to cover tonight to finish up financial instruments. So what have we done so far? So far we have I've tried to establish a strong foundation on financial instrument for you to understand and appreciate what it is. And we established that for financial instruments, that they are basically debt and equity instruments. And the relevant standards for accounting for financial instruments is IAS 32 and IFRS 9. I told you that IAS 32 deals with financial instrument presentation. And typically, IAS 32 help define some main terms that we needed, like what a financial instrument is, what a financial asset is, what a financial liability is, and what an equity instrument is. IAS 32 also helped us to be able to classify a financial instrument into financial liability and equity. And I think we spent a lot of time on that in our first class, trying to make you understand that when you issue a financial instrument, you really need to understand the substance of that issue for you to know whether it is a financial liability or equity. And I also gave you a test on that. Some of you submitted. Results will come out tomorrow, and also the solutions will be shared tomorrow. I will share it on the group on that. Then in the last class, we made progress into IFRS 9. So the focus of IFRS 9 was on recognition, the recognition and measurement. And we mentioned for recognition that as soon as an entity becomes a party to a contract, it can recognize financial instrument in its books. And for the recognition, we mentioned that first, for financial asset, that a financial asset is derecognized when the contractual right to the cash flow has expired and when there is a transfer of substantial risk and reward attributable to ownership of that financial asset. We explained that further with some questions that we looked at together. And I mentioned emphatically that before you can derecognize a financial asset, those two conditions must be present. If it is one of them that is available, you cannot derecognize that financial instrument or that financial asset, to be specific. Then we looked at the recognition of financial liability. There we mentioned that you can only derecognize the financial liability when it isn't extinguished. That is, when it is discharged, or when it is cancelled, or when it has expired. That is when you can derecognize a financial liability. Then we moved on to measurement. For financial asset, we started with equity investment, that they are initially measured at transaction price. And at the date of initial measurements, you need to also classify that equity investment. And the classification depends on whether you are holding it for the short term or you're holding it for the long term. I told you that if you're holding it for the short term, to be classified at fair value through POL, and if you're holding it for the long term, then in that case, it will be classified at fair value through OCI. Then I also talked about transaction cost. And I told you that when you want to buy shares, you will definitely incur some transaction cost. And this transaction cost, their treatment depends on the classification of that instrument, of that financial assets, of that equity investment. If you are classifying it at fair value through POL, then you expense that transaction cost. If you are classifying it at fair value through OCI, you capitalize that transaction cost. Then we moved on to debt investment. I told you that when you invest in debt, these are also initially measured at transaction price. And at the date of initial measurement, you will need to classify that as well. But in classifying debt instruments, you need to identify two tests. Number one, business model test. Number two, contractual cash flow test. For business model tests, you need to know why you are holding this debt investment. Are you holding it to solely collect interest and principal? Or are you holding it to collect interest and principal and also to sell if you see opportunity for higher yield? You see, those are the business model. You need to identify that. And the contractual cash flow test is saying that there needs to be a contract that will show that you would get interest, that will show the rate of interest you're getting, that will show the fact that, yes, you are collecting your principal back at certain date. So there has to be a contract. That's what the contractual cash flow is talking about. And I told you that on that basis, that there are three classifications for debt investments. There is amortized cost, there is fair value through POL, and there is fair value through OCI. Those are the three classifications for debt investment. And I told you that before you can classify at amortized cost, then we need to establish the existence of those two tests. Number one is the business model test. And it must be that you solely want to collect interest and principal. And of course, there needs to be a contract that will show that, yes, truly, you are collecting interest and principal. So in that case, you can classify at amortized cost. However, if the business model test is such that in addition to collecting interest and principal, you can also sell the financial asset, then you would classify at fair value through OCI. But you can also decide at initial measurement that you want to classify at fair value through POL. In that case, you don't need to look at business model test or contractual cash flow test. You just designate it at fair value through POL. Is allowed. So fair value POL through POL is a default classification in such cases. In fact, in most cases, there's no basis for classifying it at fair. It's a default. So if you don't want to classify at fair value through OCI or at amortized cost, you simply classify at fair value through POL. So it's a default classification. Then I taught you how to determine amortized cost. I used two scenarios, and I introduced the principle of effective interest rate and effective interest rate method and all of that. Then we also enter financial liability. I told you that these are initially measured at net proceeds, but they are usually classified and measured at amortized cost. And we also saw a correction to address that. And I can remember vividly, that was where I stopped last week. And I hope you have revised it. If you haven't, that's not good. I'm not sure you want to postpone revising a topic like this, because it will just be as if you did not even attend the class at all. But the good thing is that this class is recorded, so it's fine. But the earlier, the better. And you will see that I've also shared another test with you again today. So I really want to have that also by Wednesday. They are simple, they are straightforward. I just needed you to solve some questions on that measurement that I taught you last week. Look at it and see if you can get it right. Because as soon as I get that, after Wednesday again, I'll be dropping another assignment on Thursday, still on financial instruments, so that you can practice, you can have more exposure on it. Tonight, our target is to start with convertible instruments. First, let me finish this first, then I'll move to the next thing on my plan, but let's successfully finish this. So, convertible instrument is under IAS 32. I told you I was going to teach this when I'm done with IFRS 9. When I teach you those recognition and measurement in IFRS 9, then I will be able to come to this. So we are back here. So you see, convertible instruments, from the name convertible, it means that it's an instrument that you can convert. You can convert it. So the question is, there should be two questions that should be on our mind. Number one is, okay, who is converting? We can convert them. Who is converting? Number two, okay, if you can convert, we are converting from what to what now? Those are the two things that we need to answer. So, who is converting? When we say convertible instruments, who is the person converting? It's usually the issuer. The issuer. Person that wants to raise money, the issuer, is the one that wants to convert. So convert from what to what? So usually he wants to convert from liability to equity. That will always be the case, converting from liability to equity. So, which means that it's primarily a liability. Then the issuer is saying that, okay, that this liability that I have, can we convert it to equity? The issuer is saying that. So it's just like somebody borrowed me money in this class. You gave me money. You gave me 2 billion naira to invest in our school. To me, that I collected the money from you, I have a financial liability. So maybe when we were drawing up the agreement, I've already written it there that, okay, in case you choose, in case you wish, that I'm not forcing you, you can decide that, okay, instead of collecting back your 2 billion that you gave to me, that you can convert it to share capital in my business. So instead of me giving you that 2 billion back, why don't you come and become a shareholder in my company? Let's convert that 2 billion to shares. Okay? If something like that exists in that contract, when I was borrowing money from you, and that's what we call a convertible instrument. Convertible instrument. So the issuer saying that, okay, you can convert from liability to equity. So in my books now, there's a possibility that liability will then not exist anymore. Then it becomes shares. That is if the investor decides to convert. So that's the story. That's the introduction to convertible instrument. So it is also called compound financial instrument. Okay. And why is it called compound financial instruments? It's compound in the sense that because the issuer does not know, it does not know what the investor will do eventually. He does not know whether the investor would collect his money back at maturity or whether he would agree to convert. He does not know. He doesn't. So it's just like a prayer. It's just like you're praying to God that God, please, I want a Lambo, right? You don't know. You're not sure whether God would, whether you will get it or not. You're just praying, right? So that's what the issuer is doing. He's praying that if you wish, oh, instead of collecting this money back, oh, you can convert it to shares. So I won't have to give you back the money. You just become a shareholder in my company where you get dividends, right? So because of that, because we are not sure what the decision of the investor would be, right? So right from today, we would need to then account for such an instrument to have elements of debt and equity. It will have elements of debt and equity. So that's why they call it a compound instrument. Though it is primarily a debt. It is primarily a debt because we borrowed money. But the fact that it has potential of being converted to equity should the investor decide or agrees to convert. We don't know right now. We are not sure whether it would convert or not. We don't know. For that reason, we will need to consider element of the two. And I've taught you something like that before under FRS 2, if you had revised that topic. Under where there is a choice of settlements, where the entity gives the counterparty the opportunity to either settle, I mean, to allow the company either to settle in equity settle or cash settle. We said that's a choice of settlement, and I told you that we need to consider elements of both equity and debt. If you have forgotten, go and watch the video, go and revise again. It's the same thing here, compound. So that's the entire story. Every other thing is just principles. So the principle then becomes that this type of instruments, how do we account for it? Should it be a financial liability or should it be an equity instrument? Should it be, which of them should it be? Should it be equity or should it be debt?
Let me try. So,
Okay.
since you mentioned earlier that there will be components of debt and equity.
Yeah.
So for me, I think it's in between. It could be financial, it could be liability, and it could be debt instruments.
Okay. Okay, good. Okay, I just intentionally asked that question. I just wanted to know that you were actually listening. So you're correct. So instead of saying in between, you say that it's the two. That's a compound instrument. I've mentioned it already. That's a compound instrument. It will have elements of the two. So when you have a primary debt, but the issuer gives the investor the opportunity to convert to shares if he wishes, but we don't know what his decision is going to be. We are not certain of that. Okay, so that kind of instrument, that kind of issue, we are going to treat it as a compound financial instrument, or we call it a convertible financial instrument that would have elements of both debt and equity. Okay, so how do we account for this? In order to avoid, let's use a question to see how this works. So it says we have Ferry Limited, which issues 4,000 convertible bonds at 1st January 2021. The bonds have a 4-year term and are issued at par with a face value of 2,000 naira per bond, giving total proceeds of 8 million. Interest is payable annually in arrears at a nominal annual interest rate of 6%. Each bond is convertible at any time up to maturity into 250 ordinary shares. When the bonds are issued, the prevailing market interest rate for similar bonds, similar debts without conversion options is 9%. What is the value of the equity components in the bond? Okay, so this company issued a 4,000 convertible bonds, okay, at this date. So it's like he borrowed money. So this instrument, they're always in units. So the bond have a 4 years term, and the price per unit is 2,000 naira. So by the time you multiply this 2,000 naira by 4,000 units, so the total proceed is 8 million. So is this 8 million is borrowing? That's what he borrowed. So, but for the fact that it is convertible, it means that it can convert it to shares. So that's what they are saying here, that each bond is convertible to shares. And because it's a debt, so it will pay a fixed interest of 6% per annum to the investor. We are not told that when the bonds are issued, the prevailing market interest rate for similar debt without conversion option is 9%. So how do you account for the equity component? Okay, good. This is exactly the scenario I'm talking about. So even though what we did was to borrow money, but the fact that this is a convertible bond, it becomes a compound instrument, right? Because it's the investor can convert if he wishes to, he can convert actually. So right from day one, when we are accounting for this in our books, you won't just put it in your books as financial liability or equity. No, you would get element of the two, which means that this 8 million that you borrowed, you will need to split it. You will need to bifurcate it. You need to separate it into debt and equity. So the main focus is how do you do that? Because at the date when you issued, you need to recognize it. I told you recognize it at net proceeds, right? So in this case now, at this date, you need to separate this 8 million into debt and equity. So what portion is debt and what portion is equity? And the way it's done is something I've taught you before. So the first thing you're going to get is to get the value of the debt. And why are you getting the value of the debt first? It's because equity is a residual interest. It's usually considered last in all ramifications, equity. So meaning that by the time you get the value of the debt or the value of the financial liability, whatever is remaining, that's the equity. Whatever is remaining is the equity. So to solve this, at the date of the issue, which is 1st January 2021, we will need to determine the value of the financial liability first. That's the first thing we do. And to do that is you are going to get the present value of the interest, the annual interest, and you're also going to get the present value of the principal. By the time you add the two together, that gives you the value of the liability. So how do you get the present value of the interest? So The interest is payable annually. The 6%, the fixed interest, is payable annually every year. So by the time you do 6% of the principal, the money borrowed is 8 million. So we're going to be paying 6% every year. That's 480 per annum. And the term of the loan is 4 years. It's a 4-year term loan. So if you want to get present value of an annual payment, we usually use annuity factor to get the discount factor. And the way the annuity factor is determined, we use this formula. 1 minus 1 plus r raised to power minus n divided by r. That's the annuity formula. So if you punch this on your calculator, using r as 9% and n as 4 years. So you will see that we used 9% as our discount factor, which is the market rate. This 6% is the fixed rate, is the nominal rate, is the actual interest that we're going to pay to the investor. This 9% is the market rate, meaning the interest rate of a similar debt without conversion option. But I mean, just to digress a little bit, why is this 9% higher than this 6%? I mean, if we were paying 6%, why would anybody invest in our bond when they can get market rate of 9%? The question is, why is this one even higher in the first place? Can anybody give it a shot? Why this is higher? You see, this one without conversion option has more risk. There. Because if, for example, there's a default or the issuer is unable to pay back the principal, that is it. They will lose their money. But you see this one, where the issuer gives the investor options to convert, which means that even though the issuer is facing financial difficulty, if he's facing financial difficulty, the investors are still okay. That even though they cannot collect their cash, they know that they will get shares. They know that they can convert. So that conversion option makes it a little less risky. And the higher the risk, the higher the return. So the one that has more risk, which is the one without conversion option, is giving more return to attract people. While the one that is giving conversion option can have readily gives a lower coupon, which is 6%. And that's why that is lower. I just needed to mention that. Now, back to determination of this liability. I say first, you are going to get the present value of the interest. That's how you value liability. It's just for you to get the present value of all the future cash flows. That's the value of that liability. That's what you're expecting from it. So we know we're going to get interest for 4 years, 1 to 4 years, and it's 480 per annum. So to get the present value of 480,000 per annum, you use an annuity formula, which I showed you is 1 minus 1 plus r raised to power minus n over r. If you punch that on your calculator using r as 9% and n as minus 4, you will get 3.240. If you multiply this 3.240 by 480, it gives 1,555,200. For the principal, which is the repayment at maturity, that's what we're having year 4, And don't forget, we are doing this valuation at the beginning of the year so that we can enter these things in our books. So the principal we are getting back is 8 million in next 4 years. We are getting back 8 million in the next 4 years. So that 8 million, what is the value today? So we need to discount it to present value. But in this case now, we won't have to use annuity factor because annuity factor is only used when we want to get present value of annual payments. This one is not annual payment. This is a terminal payment. So we are paying this at maturity. So you just need to know what's the value today. So rather, we use this formula for that. 1 plus r raised to power minus n. So giving r as 9%, n as 4. If you punch your calculator, it will give you 0.708. If you multiply that by 8 million, we'll get 5,664,000. And that will represent the present value of the principal. If you add the two together, this 5.6 and 1.5, it gives you 7.2 million. It gives you 7.2 million. And this 7.2 million is the value of the liability. So we are saying that out of this 8 million that we borrowed, 7.2 million represent the value of the liability. Then the equity component becomes the balancing figure. That is, the money we borrowed, 8 million, minus the value of the liability. If you punch your calculator, the balance is going to be 78800. Okay, and that's why I asterisked this one to show you that it is the balancing figure that we have here. Therefore, at the date of the issue, we know that we have collected 8 million, so we can debit our bank. So we're going to credit financial liability with the value of the liability, which is 7,219,200, which are the present value of the interest and the principal. And we are also going to credit equity with 78800, which is what we got as balancing figure here. So basically, that is what the financial instrument, that's how we are going to separate the compound instrument. So that is that. So is that clear? Is that clear? Okay.
Yes,
So
sir.
now, okay. Yeah, go ahead, please. Okay. Okay, I can hear you. So now, see, this is the beginning of the year. So what then happens at the end of the year? Because this liability now, don't forget, we are supposed to be getting 6% interest. Okay, and now there is a market rate which before now I called effective interest. Effective interest is similar to that effective interest rate. And now there's equity also. So the equity is not the problem because the value of equity will not change. It will still, it's the 780 will remain 780 there. Because it's not like we have issued it. It will just be in our books like a reserve. It will be under equity as reserve. So the challenge at the end of the year is because this 7219, how do you measure it? Are you going to measure it at amortized cost or fair value through POL or fair value through OCI? So usually if they are silent, you can do amortized cost. I mean, just know that that table you did, you have to do it. That table I taught, that amortization schedule I showed you, especially now that we have fixed interest and effective interest. And if you remember the way I taught you, I said here, that in year one, that we'll have balance brought forward. In this case, the balance brought forward is 7,219,200. Then you have the interest payable, which is the effective interest at 9%. So if you do 9% of 721,900, what would that give us? 9% of 7,219. 9% of 7,219, 200. And that gives us 649,728. Okay. Then you have our interest paid at 6%. Don't forget, the interest is at 6% will always be applied on the principal. So it's going to be 6% of 8 million, the money we borrowed. That's the interest you will pay. So which is 480. So just like I've told you under amortized costs, we are saying that our interest is this, our liability is this at the beginning. The effective interest is this, but what we will actually pay is this. So we remove this. Then the balance, what is the balance carry forward? What do we have? Should have something like 7,388,928. So in year one now, this will be at the end of year one, this will be the balance of this liability. This will be what will be in our books as liability, while 780,800 still remains as equity. So out of all these figures now, which of them will go to P&L as?
Let the balance carried forward.
Okay, is this plus this minus this?
Thank you.
Yeah. So out of these figures now, which one will go to P&L as finance cost?
80,000.
Can you hear you? Which one?
40,000.
No, it's not 480. It's not 480. It's actually the 649. It's the 649. That's the effective interest. That's one. This 649 already includes this 6% plus some premiums and the rest. I think this is what we did last class. So it's this 649 that would be there. So it already includes this. So it's this one that goes to P&L as our finance cost. Okay, so you need to be able to conveniently do this. There's another question very similar to this one that you can try your answer.
Please, before you move on, what is the rationale behind using 9% for the DF calculation and not 6%?
Okay, so when you are doing discounting, when you're trying to account for time value of money, because the whole essence of this discounting is to account for time value of money. So you would use market rates. You use the real interest rates. That's the market. That's what we use when you want to account for time value of money. You cannot use this 6%. This 6% is an agreed rate between two parties, which could have been influenced by one party being able to negotiate it downwards and all of that. But for us to discount to present value, we need an independent market rate. So that's why is this 9% we have to use. Did I answer your question?
Yes, you did. Thank you, sir.
Okay. And do you know that if I continue for year 2, year 3 to year 4, this will become 8 million at the end of year 4. You can try it. Because of time limitation, I will have done it. Just the same thing I did in year 1. You bring the 73388,928, you bring it down. You apply 9% on that, whatever you get, you put it there. Your 6%, 480 remains 480. Then you cumulate, you do the math, you get your balance carried forward. You take that also to year 3, you take that to, and all of that. At the end of year 4, you see that you get 8 million value as the value of your financial liability. But just that in exam, because they can ask you something like this as part of your group account question. So you will seriously need to first be able to do this separation at the beginning of the year. But more importantly, you need to be able to do this at the end of the year. Because this is when you will now know, okay, is the effective interest that goes to P&L, while this balance here is what will show as your financial liability in the books, in the statement of financial position, while this 780,800 would go in equity as equity reserve. And that is all. That is everything about convertible instruments. Any questions? You see, when you have interest, dividend, losses or gains from a financial instrument that is classified as financial liability, such interest, dividend, loss, or whatever should be recognized in P&L. So when you classify a financial instrument as a liability, whatever interests that you're paying goes to P&L as a finance cost. But when you classify a financial instrument as equity, that you say, okay, this is equity, any dividend that you pay to ordinary shareholders, you are going to debit it directly to equity. That's why dividend paid to ordinary shares, you will never find it in P&L. You will only find it will only appear in the statement of changes in equity. That's where it will appear. Also, when you issue shares and you incur transaction costs, you issue shares, you issue share capital, you incur transaction costs, meaning maybe you paid money to brokers or you paid money to the exchange, like Nigeria Stock Exchange, you need to pay them some fees and like that. You see, such fees, which we call transaction cost, you are going to deduct it from equity. Usually is deducted from share premium. Usually is deducted from share premium. So I really, 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 really need you to note this down. Really, it's important. Okay. Okay. So that's that for that. I will have asked you a question now, but I think you have not actually revised what we have done so far. So let me not ask you so that I will not delay ourselves. Or have you revised? Should I ask? Okay, so these are some questions that you can try your hands on. None of them is outside what we have discussed. should by now, if you revise, if you haven't revised, to just be, it will look as if it's difficult, but if you have listened to my videos or you have read these notes, you see that these are very simple questions. And these are the questions I can use to ask on this topic. So, like, I think there was a day we discussed this when I taught you the recognition. So just take your time to review it, but make sure you have read the notes before you come and do this. This one was on, this one was on cryptocurrency, where they were asking us how do we present cryptocurrency in the books. I remember telling you how you, by narrow down to Bitcoin. Yeah, they wrote Bitcoin yesterday. I told you how you're supposed to present that in the books. Like revised, should remember. So you really need to try and look at these materials. Okay, we are not done. So let me quickly talk about impairment of financial asset. So where should I start from? Okay, impairment first. Impairment signifies loss of value or reduction in value. Okay, that's impairment. So, of course, usually is financial assets that can impair. If you invest, it's the investor that can suffer impairment. The person that collected money cannot, I mean, him is gaining, he's collecting money. So there is no world where you would bother about impairment. It's usually the investor. So who has financial assets? So that's why I'm very specific about the impairment here. That's impairment of financial asset. So, and before I even go deeply, remember that financial assets also, there are three. I told you that there are three. There is cash, there's equity instrument of another entity, and there's debt instrument. Okay, so I think we need to also be specific about which of that are we talking about here. Cash cannot impair. Your cash is your cash. Even though some will argue that the purchasing power of cash can reduce. And that's not the context you're talking about here. That's not impairment. That's not accounting definition of impairment. It's not loss of purchasing power. Loss of value here is loss of returns. Loss of return. That's what impairment talks about. When the return you're expecting becomes lower, then from when you're supposed to get a return of 10 million from an asset, and you're not getting a return of 5 million, there's an impairment. That's what we call impairment in this context. So cash cannot impair because cash is either the money you have in your hand, the money you have in the bank. It cannot impair. Your money will remain your money. Nothing must touch it. So the second one is equity. Equity cannot impair, even though it could fluctuate in value and all of that. But your shares is your shares. The number of shares you have will not reduce. And your dividend you get is based on those shares. So there is no scenario where the return you are expecting will reduce, except if the company folds up. But ideally, your equity investments, impairments doesn't fly with it. Doesn't fly with it. So it can't impair. But the third part, which is contractual right to receive cash, which is the debt instrument, that one can impair. Because for debt instruments, you're only hoping that the guy pays you back. It's like you give somebody your money and you're hoping it pays you back. I mean, there's every possibility that he might not pay you back. And that's exactly what we want to look at. That is impairment. That is there a possibility that you will lose your money? That's impairment. So when I say impairment of financial assets, I really, really need you to narrow your mind down to debt instruments, debt investment. Okay, I borrowed somebody money. Then we want to look at possibility that I might not get all my money back. I want to look at the possibility that the returns I'm expecting will reduce. That's impairment of financial assets. Now, again, when I taught you debt investment, I told you that there are three classifications of debt investments. There is the ones that are classified at fair value through P&L, there's fair value through OCI, and there's amortized cost. You see that one that is fair value through P&L, that one cannot impair. Because, losses are captured in that one real time. Because they are fair value through P&L. So, meaning whatever gains or losses or changes in fair value you have in those ones are already recognized in P&L. It has already reflected losses already. So IFRS 9 says that don't bother impairing that. The ones that are classified at fair value to P&L. So again, we are narrowing it further down that the financial assets, which I said is basically debt investment that can be impaired, are basically the ones that are classified at amortized cost, and also the one that are classified at fair value through OCI. Furthermore, there are other financial assets like trade receivables, right? Or, basically trade receivables. So when you have trade receivables, it can impair because there's a possibility that the customer might not pay. So it's possible, impairment is possible there. There is also lease receivable. When you are a landlord and you're expecting rent, it's possible that the tenant might not pay. That can also impair. So that's the context around impairment of financial asset. Okay. Now let me go straight to the accounting. You see, before now, when we used to have IAS 39, this IFRS 9 I'm teaching you, we used to call it IAS 39. So the way we accounted for impairments in those days, we were using incurred loss model. Incurred loss model in the sense that we only book a loss, an impairment loss, when there is a default, when the debtor fails to pay. That is when we book a default. When he has failed to pay. And it really created a lot of issues and it exposed a lot of banks, especially outside Nigeria, because banks that had risk assets that gave loans to people, and those people were not servicing the loan. And funny enough, they were still putting the loan as if the loan is still valid. And you know that banks are used to accruing for interest. So they continue to accrue for the interest. So their books looks as if everything was fine. The interest income looks healthy. The risk assets looks healthy. Everything looks fine. But it wasn't fine. The debtors were not paying. But because the accounting treatment for financial asset then impairment says that using incurred loss model, that when the financial asset or the risk asset is credit impaired, that at maturity, the guy cannot pay back principal, then that is when we write it off. So they say, it's not maturity yet now. It's not just servicing. That maybe you will still pay. Maybe you will still pay. And they continue recognizing interest that does not exist. Okay, let's leave history alone. So they did a lot of things around 2009. So around 2011, 2013, most recently, they came up with a new approach. We call that incurred loss model. I said incurred loss model. We call that expected credit loss model. It's incurred loss model we were using before, but now they came up with expected credit loss model. So they abandoned that incurred to expected. Okay, so, and that's what this IFRS 9 impairment loss model is really talking about. That's the major objective of what I quickly want to teach you tonight. That you're expected to recognize an expected credit loss for all financial instruments within the scope that I've taught you already. I already told you the scope, which I will still show you also. So, expected credit loss. So, IFRS 9 uses a model called an ECL model. We call it ECL, expected credit loss model, to account for impairment of financial asset. And like I've told you earlier, when I was explaining impairment, so this expected credit loss is just like expecting a shortfall in the cash flows. So you're expecting the debtor or the borrower, you're expecting them to pay you 2 million annually in interest. But you discover that the guy wasn't paying. Instead of paying 2 million, he was paying 1.5. Or maybe he was paying 1 million. That's already a shortfall. So that shortfall, you need to immediately start booking it as a loss. Don't just ignore it and accrue. You can't just recognize the whole 2 million as income and you're accruing the other part as expectation, as an accrual that you're expecting him to pay. No, it's a loss. You have to put it in your book as a loss, that you have lost it, which makes sense to a large extent. Is more secured. So, but it goes beyond that. So expected credit losses really wants you to look at not just an event occurring. We want you to also look at the possibility of losses occurring. So expected credit loss is saying that look into the future and estimate a possibility that this guy might not pay. So you should foresee a default before a default occurs. And in doing that, you need to understand your past transactions with that counterparty. You need to look at what is happening in the economy, the current condition. If there's a government policy that affects the industry in which that counterparty is operating and would affect his ability to repay his debts, then you need to, those are indicators that will show you that this person might fail to pay. So that should drive recognition of losses. And you could look at some other reasonable and supportable forecasts as well. So expect that losses would occur. Not when those losses occur. That's when you book it. You should expect that they might occur. And that's how we book losses now, which we call impairments. So The objective of IFRS 9 is recognize expected credit losses for all financial instruments, specifically financial assets. So because we believe that if you use an ECL model, it's going to provide more useful and timely information to users. Because by the time you borrow me, I collected 10 million from you. And you, in your books, I've already told you I'll be paying you 10%. A year after I collected that money from you, the contracts that I used that money to fund, that contract was withdrawn from me. So if that kind of event occur, you don't need to wait until I start defaulting before you impair that kind of financial asset. You need to write it off as uncollectible. You need to expect a shortfall in contractual cash flow. And that's the whole idea of expected credit losses. And like I told you, the financial assets that we impair, the scope of this standard really focuses only on financial assets measured at amortized cost and financial assets magnetically measured at fair value through OCI. The one of fair value through P&L is not included. There are some other financial assets like loan commitment, financial guarantee contracts, lease receivable, contract assets. Those ones also are impaired. But the one I really want you to have at heart that ICAN can ask is for you to know that the financial assets measured at fair value through P&L are not impaired under this impairment model we're talking about. So here now, you see, this ECL model we are speaking of, I've done a little introduction about it to you, and it's really not more than that. And again, what I've mentioned so far is that this model is saying that don't wait until you suffer a loss. Don't wait until the counterparty defaults or the customer fails to pay you before you book a loss. You need to expect that a loss might occur. So you need to expect that you would suffer credit loss. And this credit loss, like I've mentioned, simply means shortfall in cash flow, shortfall in contractual cash flows. That's the whole idea. And it shows that there will be a lot of estimates involved. You're going to make estimates because you are trying to predict the future. We know that some people can take advantage of that since you are allowing them to determine what loss they will. There are some very smart account people that will say, okay, I expect that we'll have this loss this year. I mean, otherwise, they might not be honest with it. So it's now left to the auditor to look at the substance of the transactions and they calculate it for them. So usually it's auditors that does most of this calculation at the end of the year. But really, it's a loophole there because when you allow this so much estimates by users, they can misuse it. Some people can use it for what we call profit smoothing. Profit smoothing, where in a year that they need their profit to be small, they would recognize huge loss that we're expecting that will make huge loss. This person is not doing so well. Or the year where they want to make their profit looks very big, they will recognize very small loss. So people that can play around with this ECL model because it makes use of a lot of estimate. We are saying expect that there will be shortfall. So meaning there are not so much facts available. It's just for you to look at past events with these customers, current condition, and other forecasts like that. to make an estimate. Okay, so that being said, so what we have tried to do is this ECL, this expected credit loss. So we said we put it into two. We have lifetime ECL and we have 12 months ECL. We categorize them or classify them into two. That, okay, when you are recognizing this impairment, this ECL, expected credit losses, separate it. Call one lifetime ECL, call another one 12 months ECL. You see the lifetime ECL, that one is saying that you're saying that this should be losses. These are losses that can result from all possible default events over the expected life of the financial instruments. Meaning that if the assets, if the customer is supposed to pay over 5 years, so you need to sit down and make some estimates that, okay, what are the events that can happen that will make this guy to default over these 5 years? So doing that, trying to identify possible default events over those periods, over that long period, over the lifetime of the financial assets, of the financial instrument, that's what you're doing is a lifetime ECL. Rather, they call it lifetime. There's another one called 12 months ECL. So these are losses that result from default events that are possible within 12 months after the reporting date. So this one has a restricted scope, that what are the possible default events that can occur within 12 months? That one, we call it 12 months ECL. So the way it works, the way it usually work exactly is that when you invest in debt instruments, IFRS now requires that you would classify that instrument into stages. So for you to impair that financial asset, you need to classify it into stage. The stage one, any financial asset that you put at stage one is the financial asset that you just originate or purchased, which means that all financial assets must be at stage one. Anytime you invest in debt investments, you invest in debt, anytime you lend somebody money, expect that, we are saying that put it in stage one, expect that there might be default. And the impairment model you use is a 12-month ECL, which is recognizing losses that might occur within 12 months. So as soon as you lend somebody money, immediately you need to recognize the 12-month ECL, which is that you estimating is really an estimate. You estimating that this person might default within 12 months. That is what 12-month ECL means. That possibility of losses within 12 months. We call that 12-month ECL. And the standard says that it could be zero. I mean, since it's an estimate, you could look at, this particular customer is credit worthy, he doesn't default, he pays on time, and he's doing a good business. So my 12-month ECL will be 0%. 0%. So, and if it's the one that you have a not so good history with, you can estimate 5%. So it could vary. But the key point here is that all financial assets that you originate, you put them in stage one, and you need to impair them immediately. And you use a 12-month ECL by looking at possible default events within 12 months. At the end of the year, they move to stage two. At each reporting date, they are at stage two at the end of every year. And what is happening at the end of the year? So you would need to remeasure that ECL. You will need to recalculate it. And how do you recalculate it? You do that by assessing credit risk. Credit risk means default, possible default, risk of default. So you look at whether the credit risk has increased. So if the credit risk on that asset have not increased, it is still okay if it has not increased. So you continue with your stage one, with your 12-month ECL. And note that while you are making a 12-month ECL, both in stage one, the effective interest will be calculated on the gross carrying amount, meaning that even if you determine an impairment loss amount, you will not still consider that impairment loss in calculating your interest, right? Because we don't want you to distort your interest. Because this 12-month ECL is still an estimate. We are just saying possible default event. It's not like the person has actually defaulted. So why reduce your interest? So your interest is still calculated on the gross. Don't touch your interest. Okay? So don't say, because I've accounted for impairment now, so the interest should be on the net. No. It should still be on the gross. And don't forget, this impairment loss, okay? Let's say you have a loan note of 10,000, and you say that, okay, I want to do a 12-month ECL of 1%. That means you calculate an impairment loss of 100. Let's say 100. So it means that the value of this 10,000 that you have now is now 9,900. Abi? So because the double entry for this 100 is first leg will go to P&L. The second leg will reduce your assets because we are saying that we have lost 1% of this. So what we are saying around this interest is that while it is still at stage one, or while you are still making a 12-month ECL, whatever interest you're expecting, whether it's 10% interest, still calculate it on the gross, not on 99. Because this 1% ECL is just an estimate. The guy has not actually defaulted. So I needed to clarify that. Okay, I was at stage two. I said at the end of each year, you leave it at stage two. And what you're looking at is that as credit risk increased, is there anything happening in the guy environment? Because when we say credit risk increasing, we're looking at the current condition of that counterparty, of that customer. You're looking at the economic condition or economic reality of that customer. That is he facing difficulty? Has he lost a major business? You need to understand his industry. You need to understand what is happening with his business for you to know whether credit risk has increased or not. So when you do that assessment and you see that credit risk has not increased, then you still continue with your 12-month ECL. But if credit risk has increased and it is not considered low, then immediately you have to make a lifetime ECL. And from this example I'm making, when I say you're saying that 1% will be lost. When you move from 12-month ECL to lifetime ECL, what it simply means is that the interest, the possible events, the possible default event has now increased. So instead of 1%, you might be looking at maybe 10% or an higher percentage of loss. That's just the significance of this lifetime ECL. But you know that you only get to this lifetime ECL when credit risk has increased. Not that the guy has defaulted though. It's just that maybe the guy is facing some hardship. Even if he has not defaulted, but you should have identified that. And immediately your impairments should be based on lifetime expected credit loss. However, it becomes stage 3 if the credit risk increases to a point that it is considered credit impaired, meaning that there is now a default event, meaning that the guy is supposed to pay you at a date and he failed to pay. Probably you allow him 30 days and he didn't pay. Immediately you put him to stage 3. Even though the ECL you are still making is still a lifetime ECL, but you are taking him to stage 3 because he has defaulted. And interest now, because now he has defaulted, interest should now be based on amortized costs. That is the net carrying amount. You need to now deduct whatever impairment loss calculated from the gross because now he has defaulted. So interest should be based on the net, which you call amortized cost. And that is everything around impairment of financial assets using expected credit loss model. Any questions before we start solving questions? Okay then, let's look at this question. PayCo has a portfolio of 50,000 financial assets, debt instruments that have 2 years to maturity and currently accounted for at amortized cost. Each asset has a coupon rate of 10% as well as an effective interest rate of 10%. Okay, so this guy borrowed some people 50,000. So that's why they call it debt instrument. So coupon rate is 5%, which means that you're supposed to be getting 5%, 10%. He's supposed to be getting like 5K every year as interest. Okay. So they said no previous loss allowance has been recognized as the 12-month ECL was assessed to be nil and there had been no significant change in the credit risk since the portfolio had been acquired. So they said this is stage 1. Yes, this is stage 1 from what I've explained earlier. So since there has not been significant increase in credit risk, and we have been using 12 months ECL, so it's still at stage 1. But at the end of the year, you take it to stage 2, where you will measure the ECL. So let's look at if credit risk has improved or increased. We're told that information has emerged that the sector in which the borrower operates is experiencing tough economic conditions. Okay. Then that means credit risk has increased. Credit risk has increased. The guy is facing tough economic conditions. So it is now felt that a proportion of loans will default over the remaining loan period, and therefore credit risk has increased significantly. After considering a range of possible outcomes, the overall return from the portfolio is expected to be approximately 6%. You see, what was 10% before? Now, because of the tough economic condition, what we are expecting, you see, this one, not that the guy has defaulted, though. He has not. But you need to estimate that he might default. So this is just an estimate. So we expect that it's only 6% we will get for the next 2 years. So the debt instruments are not, however, credit impaired. So here is telling you that they are still servicing the loan. They are paying. It's not credit impaired yet. But for the fact that the guy is experiencing tough economic condition, we need to expect that he might not be able to meet up again. So we're now required to calculate lifetime ECL and also the loss allowance required. Okay. So remember that what the lender was expecting is 5,000 a year, which is 10%. But now we are only going to get 6%. So that means there's a shortfall. There's a loss of 2,000 naira every year. And this loss is for the next 2 years. So the way we calculate ECL, in this case, lifetime ECL, and lifetime ECL, because credit risk has increased significantly, you make a lifetime ECL. So you see this 2,000 naira per annum that we're going to be losing every year. You will need to get the present value of that. And how do you get present value? So year one, 2,000, we'll do the discount rates at 10% using the effective interest. If you do 1 plus r raised to power minus n, it gives you this. Multiply that by 2,000, it gives you 1818. You do the same thing for year two. So by the time you add the two together, this is the present value of that 2,000 for 2 years. And this 3471 is what you're going to recognize in your books as loss allowance. This is how you calculate ECL, expected credit loss. This is how it's calculated. Just for you to see, okay, is this guy facing difficulty? Okay. What are we getting now? Let's estimate a certain reduction. Then you look at, okay, how many years are we going to experience this reduction? And you can vary the reduction over the years. It depends. I don't know if anybody has done it before in practice or in real life, but it's exactly what I'm showing you here. That's exactly how it is done. So you discount all those losses because we don't recognize future. These are future losses. It's not like we have lost it. We are just expecting that we will lose it. So we don't recognize future figures in our books. So we discount them to present value. That was the value of that loss today, which is what you do with present value. And with this now, we're going to recognize this 3471 is in our books as a loss. So one leg, this loss now, it just goes to P&L as a loss, debit P&L, and we're going to credit financial assets. Okay, we'll credit the financial assets. So instead of 50,000 in our books, it to be 50,000 minus 3471. And remember, since it is not credit impaired yet, Okay, the interest will still be calculated on this 50,000, the interest revenue. Since he has not defaulted, we are just still expecting that he might default. And that is all for this question.
So please, I have a question.
Okay, Priscilla.
Um, just to go back to when you explained annuity rate and discount rate. So in this case, if we wanted to use annuity rate, does that mean we then now consider like 2 years as at once, as opposed to breaking them down?
Oh, yes, Priscilla,
Yes.
yes. That's even a better one. Instead of doing 1, 2, and all of that, since they are the same amount, you can just use annuity factor. It will just give you 3,471 straight. Yes, you can do that. That's very correct. That's very correct. Let's look at this other scenario. So there's a bank that operates in Nigeria, a region in which agriculture is a significant industry. So the bank they provide personal loans and mortgages in the region. So the average loan to value ratio for all its mortgage loans is 75%. So which is good. So average loan to value ratio. Who knows what that means? Anybody? Okay. That means nobody works in the bank here, or nobody works with in that department. So loan to value ratio is that you always put down a collateral when you want to borrow money. So we are saying that the loan amount is like 75% of the value. So meaning that if you are giving you 1 million, your property you are bringing should be more than that 1 million, in such a way that 1 million is just 75% of that property. So that's loan to value ratio. So 75% is good, even though, yeah, 75% is very good. But it doesn't really have impact on. It's just showing that this is a mortgage loan, and those property, they have good values. So then I said all loan applicants are required to provide information regarding the industry in which they are employed. If the application is for a mortgage, the customer must provide the postcode of the property which is to serve as collateral for the mortgage loan. We're now told that Asset Bank applies the expected credit loss impairment model in IFRS 9 financial instruments. The bank tracks the probability of customers' default by reference to overdue status records. In addition, it is required to consider forward-looking information as far as that information is available. Asset Bank has become aware that a number of farmers are losing revenue and profits. They are losing revenue and profits as a result of Boko Haram unrest, and that several are expected to close. So how should Asset Bank apply IFRS 9 to its portfolio of mortgages in the light of changing situation in the agriculture industry? Okay, so from what I've taught you now, from here, where they told us that Asset Bank has become aware that a number of farmers are losing revenue as a result of Boko Haram unrest. I mean, this is what we call increase in significant credit risk. It means credit risk has increased. So that means this loan, Asset Bank needs to classify the financial asset at stage 2 because the farmers are losing revenue and profit because of Boko Haram unrest. So that signifies increase in credit risk, significant increase in credit risk. So he put it in at stage 2. And at stage 2, remember that he will be making a lifetime ECL. And that's the solution to this one. So the question continues that later in the year, more information emerged and Accept Bank was able to identify the particular loans that defaulted or were about to default. How should Accept Bank treat these loans? Okay. So they said later in the year, more information emerged and they were able to identify the loans that defaulted. I mean, this shows that they have actually defaulted. This shows that there is a credit impairment. That means you need to put these loans as stage 3. You need to now classify them as stage 3 because they have defaulted. Of course, you still make lifetime ECL, but the interest income you recognize will now be based on net carrying amount. That is, whatever impairment loss calculated must be deducted from the gross carrying amount first. Then whatever balance is what you calculate your interest on. Because they have defaulted. There's a default now. Any questions? I hope you're getting these things. Okay. Let me show you one question ICAN asked. So the last time they asked it. Yeah, this is where ICAN asked it the last time. They have not really asked so much about it since then. So they said that Abacon Bank is a microfinance bank which has recently made the transition to IFRS 9 financial instrument. The bank is working through the classification and measurement provisions under IFRS, and I have requested your firm to provide some guidance. You are the senior consultant on the engagement, and the following notes were taken during the meeting you have attended. He said, in addition to the investment in debt instruments, the bank also has investment that are classified at fair value through PRL. The gains or losses on this investment are recognized in PRL. The directors do not recognize a loss allowance for expected credit loss on these investments. Required comment briefly if a loss allowance for ECL is to be maintained by the bank in relation to the financial instrument measured at fair value through PRL. Based on what I've taught you, can you recognize loss allowance on this financial asset? Anybody?
I feel no.
Why?
There's no indication to the fact that they've actually, like, some people did not pay back or there was any defaults from customers of the bank.
Okay.
Yeah, like, there won't be.
Okay. So, yes, they should not make impairment loss. And the reason is because I told you earlier on that financial assets that are classified at fair value through PRL, you don't make impairment loss for them. You only make impairment loss for debt investments that are classified at amortized cost and fair value through OCI. Okay. Otherwise, so the one, what's this? Can't remember your name. The one you were talking about will not fly, because I told you that all financial assets, okay, that is the ones that is within the scope of IFRS 9, must be impaired and must be put at stage 1 from origination. So immediately you borrow somebody money, immediately you lend money to somebody, you must calculate a 12-month ECL. Okay, so the direction you are looking at it is not it. Okay, because all of them must expected credit loss. I mean, the whole idea of what I've taught you today is that don't wait until default events happen before you classify them. That's why we have stage 1, stage 2, stage 3. So stage 3 is where, okay, default event has happened. Then you put them at stage 3. That one, I mean, the loss you calculate will be higher and your interest will be based on net carrying amount, and that's at that level. But the reason why you will not impair in this case is because the guy classified the debt investment at fair value through P&L. But to really get 7 marks, you need to do some explanations to the examiner. You need to tell the examiner what impairment loss we have. That where there is credit losses, you make impairments, you make either a lifetime ECL or a 12-month ECL, and you would advise the bank that it should maintain loss allowance for financial assets that are measured at amortized cost and fair value through OCI, lease receivable, and contract asset. And of course, the examiner will see that fair value through P&L, you don't make impairments ECL for those ones. It's not included in the list that IFRS 9 recommended. So really, you just need to know these principles, and your exam is going to play around. It's going to play around that. So aside all of this, there is because trade receivables also, you can recognize impairment loss on trade receivables. But for trade receivables now, there is a way, they allow this a slightly different approach for trade receivables for your customer from other financial assets. So if you choose, you can do the stage 1, stage 3 for trade receivables, but they know that companies usually maintain like an aging schedule for trade receivables. So they want you to apply that when you want to impair your trade receivables. Like this company now, he already has like an existing policy in place for trade receivables. And this from the question. The guy says that any receivables that is overdue or that is not overdue, we will still make 1% loss provision. So that means they will still write off 1%. Anyone that is 1 to 30 days overdue, we will write off 5%. Anyone that is 31 to 60 days overdue, you will write off 15%. And like that, and like that, and like that. So in this case now, in this question now, we sold goods to this guy on 1st of June, and we gave him 60 days. Okay. And the guy has not paid. He didn't pay within that 60 days. Right? Because we sold to him in June, and this is already 31st of July. So that means his credit is now overdue by maybe 1 day. Just 1 day. You know that we allowed him 60 days to pay. And from 1st of June to 31st of July is like 61 days. So the guy is, after his 60 days credit limit, he's now overdue by 1 day. So that means we need to make 5% loss provision. And that's what I calculated here. I debited loss allowance and I can credit provision for loss allowance with 2,000. Okay. So for trade receivables, the standard tried to make it a little easy for us. So I just need you to note that. They can ask you, and well, I don't really see them asking you this one because it's quite straightforward. But just have it in mind that the stage 1, stage 2, stage 3 might not really work for trade receivable. So this long question you're saying here is still the same. It's still talking about trade receivables. And this is the metrics that the company uses. So anybody that has not defaulted would make a loss allowance of 0.3%. Anyone that is 1 to 30 days overdue, 1.6%, like that. And you see that the credit loss allowance that they are making is just this multiplied by the gross amount. So for this particular receivable now, they have already, there's a loss of 1,160. So the questioner gave us another person that is owing 68 million. So they now give us, okay, these are our metrics. So that's okay. If it's at 0.5%, the gross carrying amounts, the ones that are not owing anything, that are not overdue, is 32,000. The ones that are 1 to 30 days overdue, 1.8%, but they are just 16 in terms of value, like that. So they now say you should complete this matrix, okay, and show the journal entry for credit allowance. So all they just want you to do is just calculate the credit loss allowance from this table. Just multiply this by this for each of these figures, which I did below. So resulting in this amount, 1648. Okay. Now this 1648, because at the beginning of the year, because this was last year, we had loss allowance of like 1160, and this is the current year. We are now having a loss allowance of 1640. So what goes to P&L as loss is the increase in that loss allowance, which is 1648 minus 1160. Is the increase in that loss, which is 488. Okay, because since there is a balance in our books before, so we're going to carry forward, and we're still looking at the receivables is not like we have new set of receivables. It's just, it might increase, it might decrease. It's still the same set of receivables. So since last year, the loss was this year it is now this. So it means that the loss has increased from 1160 to 1648. So that's the whole, that's for trade receivables. So trade receivables is that the standard expects organizations to have their own policy, that any receivables that is 1 day overdue, okay, we would make a provision for loss allowance of 2%. So if the examiner wants to ask you something like that, they will definitely give you that schedule All you just need to do is just calculate the loss allowance and put it in your books. And that's all for impairment of financial assets. So do we have any questions? Okay, so me, I've taught you this. And you really have to make effort on your part as well to try and revise these things. And those questions I'm sending you, they are really important that you solve them, because I'll be dropping another one on ACL during this week after you have submitted these other ones. And I will also be those, I don't know how I will send you the solution, and I can even do a video for the solution, but we'll see how it goes. I really need you to study these things, not just listening to me, then you dump it after all. Just try and study it and see what you can make out of it. So next week, we are going to be looking at fair value measurement. That's fair value measurement is a quite very short standard. So I don't know which one I will do next. Maybe IFRS 16. I think it should be maybe IFRS 16, or maybe I will teach you impairment of non-current assets, either of the two. But the immediately next standard I'm teaching you is fair value measurement. But for now, I think we're going to close our curtain for tonight. I'll see you in the next class. Have a wonderful night.